Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, February 15th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
Doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, we had another volatile week last week. Obviously we had we started out with kind of a little stutter step on Monday, and we had a sharp two-day rally. And then that was followed up with a 500-point dive by the Dow on Thursday. And then on Friday, we had some more selling after the tensions between Russia and Ukraine, kind of picked up again. Now, we did have strong Q4 earnings last week. We had a wide array of companies, including Tyson Foods, Harley-Davidson, Walt Disney, Chipotle. Companies like that reported earnings. They were blowout numbers, looked good. Their forward guidance was strong. They see the economy improving. That looks good for the market. Then we also had a hotter than expected CPI on Thursday, which they were kind of hoping that analysts were kind of hoping that we would start to see maybe a little bit of a peak and maybe a little start to pull back on the inflationary data, and that didn't happen. And then again today we had the PPIs, and the wholesale prices were also much higher than we were looking for. Today, their January PPI was up 1%. They were looking for up 0.5%. And worse than that, we're up 9.7% year over year. So that sent the rates higher again. I'll go over that. We actually fell back a little bit on Thursday and Friday with the tensions going on overseas. But today, we're back above 2% on the 10-year and actually about 2.3% on the 30-year. So that's going to keep a little bit of a cap on the market here. But let's go forward. Yeah, then Friday, after that CPI came out last Thursday, St. Louis Fed President James Bullard came out with some more hawkish statements. He was calling for a 1% hike in rates by July. That's not what the market's looking for. That kind of instigated the sell-off. And then in the afternoon, when you had the Russia-Ukraine thing pick up a little bit more, that we got a second leg down. To put all the markets down for about 1% for the Dow. I think the Nasdaq was down about 2%. And after Bullard's comments and all, again, we saw the 10-year jumped above 2% for a little bit, came back a little bit on Friday. But we also saw the CME FedWatch, which is a tool that it's basically what traders looking at with their money. They expect it just shows you what the odds are, the chances or probabilities of what a rate hike is going to be at each meeting. And that jumped up to 96.7% on Friday. That's up from like a 2% chance of a 50-cent rate hike at the beginning of the year. So that got traders pretty nervous. The market doesn't like to see big jumps like that and rising rates. And I don't think we're going to see a 0.5 point at this one either. I think the market's going to settle in here. We'll probably see a quarter. Fed President Powell's been pretty consistent in what he's been saying, that there's something they want to work on, but they don't want to rush into something and scramble the market here, where also we get a big pullback while they're waiting to see if inflation, how sticky it's going to be. So I still expect to see a quarter rate hike, but I do expect them to maybe have a little bit more hawkish tone, saying that we're going to be data dependent, and if we have to raise it a 0.25 point every meeting, that's what we're going to do until we get a grip on inflation and kind of rein things in. So as of today, I believe I looked at it today, and the CME FedWatch tool was down to about a 50-50 shot of a 50% or a 50 cent or a quarter rate hike at the March meeting. So I'm still inclined to believe that we're going to see a 0.25 point. So that the market should be fine on that. Now, crude oil prices jumped on Friday. The CRB index went up to a new high. Crude oil prices hit their highest rate, I think, yes, it might have been yesterday even. They got up to $94, $95. That's the highest since 2014. So that's causing a little bit of, that's more inflationary. But they did pull back today, luckily, with with talks that the Russia, still is open to negotiations and not just going to jump in and invade. So, got a lot of stuff going on that's moving the market. Most of it's just off of headline noise. And these are things I want to talk about a little bit later, because sometimes you're wondering, oh my God, the market's, we're going down big. Well, now we're going up big. What do I do? Do I jump in? I'm going out. I want to jump in then and then jump out when it's going down. So we're going to talk a little bit about how you should maybe gauge some of these headlines and how to kind of filter through some of the noise. Last week we saw gold spike up to the highest level it's been since like last October, November. And of course, anytime you have these military type things, you're going to have a flight to safety, and that's why bonds kind of pulled back on Friday. The yields, and you saw gold spike up. And gold did fall back pretty good today, a little bit on that. Okay, as far as the sectors go last week. They were mostly lower. The rate-sensitive and growth sectors were the worst performers. Technology, REITs, communication services, consumer discretionary, utilities. They were all down more than 2% last week, while energy, materials, and financials ended the week higher, which is what you would expect. As the rates go up, it's going to be good for the banks and all that. And, of course, with crude oil going up, the energy sector, and it's going to be good also. So at the end of the week, we were down. We snapped a 2-week win streak that the major averages had. It wasn't much of a win streak, but we'll take what we can get in this environment right now. The technical condition of the market did deteriorate with the late week sell-off last week. Despite better than expected earnings, we're still having some problems where the major averages were, as of yesterday's close, all below the 200-day moving average. That means we're basically in a downtrend in the market. One positive, if you're going to pull something out from last week, was that the Russell 2000 was actually up, and it was higher for a second straight week, but it's still below the 200-day moving average. So that's something we want to take a look at. Even today, with this big rally today, we actually it's still way below the 200 moving day average, but we did get up to the 30-day moving average on that thing. So it's very oversold still, and I'd like to see we could go up another 40, 50 points before we're going to see the small cap Russell 2000 really start to make some headway in here. Okay, internal breadth was negative. But we didn't see a lot of panic selling. Will, can you go to the market recap? And we'll take a look at some of these breadth indicators that we talk about. If you go on the home page on the right-hand column, you'll see the little link there for the market recap right below the performance things. Okay, let's go down. Let's take a look at this advanced decline lines. On the left here, you'll see the NYSE advanced decline line. You can see that's been working its way lower pretty steadily. I think the last time it made a new high was in November. Same with the NASDAQ. The NASDAQ looks worse, and the reason that is because you have a lot more junk stocks in the NASDAQ. We did have a pretty nice bounce in the AD line for the NYSE, but as you can see here now, we've kind of had a little bit of a bounce, and now we're heading lower as of last week. It wasn't a lot last week. I think we were only down a couple hundred units, which isn't bad, but it's just that as long as you're having this stepping down in the AD line, that's not a sign that we're getting ready to turn around a little bit. A lot of times what you'll see is you'll maybe see some sideways action in the indexes, and then you'll see the AD line start to be moving up while the market's not really doing much. Now, that's called positive divergence. That's something that we want to look at before we think this is going to be more than just dead cat bounces that we get here. Going down here, we'll also look at the new highs and new lows. This is another point that you want to take a look at. The green line represents the new lows, and the NASDAQ, I think it's now up to 13 weeks in a row, we've had more new lows in that index than exchange than new highs. That's not something that you want that you want to see. That's not a market that's getting ready to break out and challenge the old highs again. So that's just something that shows that we're, at best, we're in a trading range for a couple of weeks till the next FOMC meeting. Let's go down a little bit further. Okay, now here's one thing else I want to look at here on the VIX. Now, I want to bring this up because you can see here on the VIX just a couple of weeks ago, actually on Friday, we actually got all the way up to 30. Yesterday, we also, at the start of the day, I think the Dow was down more than 300 points early in the session, and that got the VIX back up here close to 30, which is where you'd like to see, a lot of times when it gets above 30, that's where you start to see buyers come in. That's what happened again here the last couple of days. Now today, it's kind of surprising. Let me check here real quick. Today the VIX is at, we're down to about 26. I thought it was a little bit lower than that today, but it's down about 8% today. So we're starting to move in. People are a little bit more are fairly comfortable with this move, but again, it's not a move that like everything's over just because we have a little bit of geopolitical issues that are coming off the board. Let's go ahead down a little bit further, Will. Some of the things we talk about in the weekly market letter is sentiment indicators, and sentiment indicators are whenever they're okay to watch. What you want to take a look at those when they start to get to extreme levels. That normally is when we're getting close to a top or to a bottom. As you can see over here, the weekly bullish percent of the advisors. That means that most of the advisors out there. Last week we were all the way down to only 34%. Are actually bullish on the market going out, going over the near term here, and we're up to 25.9%, which is almost 26% are bearish on the market. That's not overly too high, but 34% is very low on the weekly bullish advisors. And it's funny because rather than just going bearish, the advisors looking for a correction jumped up to 40%, and that's one of the highest we've had since I believe back in April, I think, when they were looking for a correction, which means they're looking for at least almost a 20% pullback in the market. So we're getting overly bearish on some of these sentiment indicators. I also talked a little bit last week. Let's see here. We talked about the AAII, which is the American Association of Individual Investors. Historically, in that poll, you're going to see about 38% of the investors are going to be bullish. We're all the way down to 24.4%, which is, I think that was something about an 18-month low on the bulls. Last week, where there were 43% of the individuals in that survey were bearish. That was about a 16-month high on that. So individuals are still a little shaky. As far as the hedge funds go, they've moved up a little bit over the last 2 weeks. They got down to about 53% equity exposure here about 2 or 3 weeks ago. We're all the way back up to 66.8% now. So they're nibbling away down here, which is actually a good sign. That's a neutral on that exposure. When it gets up around 90 or higher, we start to think that they're starting to get a little bit overly bullish. So they're still neutral, but it is inching up, and that's a sign that the pros are pretty much think that we may be close to a bottom, and it may be time to maybe add to a little bit of these positions. So as far as things go right now, we did get a nice bounce today. You kind of knew that anything that happened between Russia and Ukraine was we were going to get a relief rally, and that's kind of what I'm looking at this today as kind of a relief rally over that, but we still maybe have some issues.
Well, it's nice to see the market bounce back today after some de-escalation in the Russia-Ukraine conflict. Does this look like something the market can build off of and maybe work higher?
Well, yeah and no. I've been talking a little bit in the last couple of weeks in the market letter that historically, when rates start to rise, you are going to see the market pull back, and it just you have to come to terms with that, and also how many rate hikes we're going to get. If they were just talking about 2 or 3 rate hikes, you probably could start to build off of this. We've had the good sell-off. We had the NASDAQ down like 16%. You've had a kind of a reset of valuations a little bit, though. Overpriced big caps are off. I still think there's something like, I heard this morning, there's something like 40% of the stocks in the NASDAQ are down like 40%. So you have had quite a correction going into this rate hike deal, but now that they're still talking about Goldman Sachs said the other day they think we could have 7 rate hikes. That would get you up to almost 2% on the 2-year. That's quite a ways away, and that certainly is going to stifle price gains at this point. However, what you want to look at when you have these little relief rallies, that type of thing in the market. Can you go to the charts, Will, for a second? And what's important, what you want to do is you want to kind of filter through the noise. You have all this. You have the PPI, the CPI. You have Bullard coming out here talking about we got to raise rates. Inflation's going to the moon. The Fed's behind the 8 ball. And then you have the other side talking about Ukraine. We may go to war. We have all these things going on. Pull up the S&P 500 on this chart. Okay, these are the times again when you have to start to look at your. You have to kind of filter through the noise. Okay, what's going on here? As you can see on this chart here. Okay, the S&P 500. Yesterday we're back here below the 200-day moving average, and when that's below the 200-day moving average, that's we're basically in a downtrend, and that doesn't mean so. When you have these bounces, that one day does not make a trend. That's an old phrase they use on Wall Street. And that's something that we want to look at. Now, when to avoid the noise, if you go to the charts, put in your 50-day. Maybe you put in your 100-day. That's another one I like to look at. In fact, we'll take out the 21 and put in the 100. If you put these on your charts for your indexes, and they also work really well on your individual stocks, so we'll look at something else for that too. You can see where you have these moving averages coming in here. Now, today's bounce on the S&P 500, as we talk right now, we're at 44.64, and basically what you have is you've got the S&P 500 came right up and just nosed over the 200-day moving average. Okay, that's nice. There's not going much farther. Now go ahead and put the Dow Jones up. Okay, now you have that where we were below the 200-day moving average again. Well, today's rally took the Dow Jones up to 35.47, and guess where the 200-day moving average is? 35.47. So today's relief rally took the Dow Jones exactly up to the 200-day moving average, and that is where it stalled out. Now you may get a little bit of you may flirt with that over or under just a little bit at the end, but now we're back down to 34.965. So we're about 80 points off, back below the 200-day moving average on the Dow. So when you see these relief rallies where you have these big days, we're up 400 and 500 points. You're going to see these things usually stall out at these what we call key moving averages. Then if once this thing starts to get around, maybe when it gets over the 200, you'll see these averages start to bounce around that. The SOX, which is the Philadelphia Semiconductor Index, is up about 4.5% today. Big move, correct? Yes. Okay, but it took the index just back up to the 200-day moving average. And the SOX, again, is kind of just, had some big moves here by NVIDIA. Micron was up big. Marvell was up. Lam Research. But again, the rally in that thing is stalling out just right around at the 200-day moving average. So there's going to be signs in here where professional traders are going to say, okay, well, this is probably until we get some more news, where I'm going to take off some of my positions. I got this through the relief rally. I'll skim it back a little bit from here, and then I'll look maybe to short the next rally. The main thing I want you to think about in here is the market usually pulls back a little bit once once we get that first rate hike. Now we haven't even gotten the first rate hike. It's all about a lot of times the Federal Reserve is actually behind the eight ball, and it's kind of determined by the market itself. Like, so when you go to the Wall Street Journal and you look up what bonds and rates are doing, you'll get a better example. The market's going to tell the Federal Reserve what it wants to do. And right now, the 10-year note, as we speak right now, is at 2.04, and the 30 years at 2.35. So it's telling you basically right now that this is where we're gonna go. And the Federal Reserve is, even though they say they're not market dependent, they know exactly what's going on in the market, and they don't want to upset the card. They come in here and they raise a half a point and say, we're really going to get aggressive on this. You're going to get a big sell-off in the market, and they don't want that, because if the market gets a big sell-off, then they're really going to be behind the eight ball, because now they're raising rates to fight inflation, and you're getting investor sentiment going down at the same time, which can be a real problem. Now, if you're looking at individual stocks, the same type of thing when you see the relief rally. Let's just say you're looking to get in or get out of a stock. Pull up something like Microsoft on here, Will. Okay, now so something like this. If you go ahead and put up the Fibonacci, and let's go to that high on this thing back in the end of December, and then take it down to the low around 278 or so. And in this case, you're going to be able to see, where you're going to get, buy and sell opportunities in these stocks. Okay, right now, if you take it down to the low, a 50% retracement of that high would take Microsoft up to 310, and we're not even there. Today we're up to about 298. So what we've recovered on Microsoft is you're looking probably for this thing to maybe stall out on rallies somewhere around the 38.2% Fibonacci retracement. That's going to put Microsoft around 303. So if we get a couple of good days, you're probably going to get a bounce on up to around 303. If the market we get a couple more news where maybe Russia just says, hey, we're giving up completely, then probably you can get a spike up to 310. Now these are areas that you want to if you want to buy some protection, if you're in here fighting for the next 2-3 months, that would be an opportunity maybe where you could sell some covered calls to bring in a little bit of premium, so you can maybe pick up a couple of bucks on a position you're holding long term, but you don't expect it to do much more. At the same time, if you get to around 310, maybe you can buy a put on that as we go into the next into the rate hiking cycle. That would be another way to maybe just protect some of your bigger holdings as we move forward. So these are some areas on the charts that if you look at them that way and realize that most of this noise that we're seeing right now with the big swings up and down is just noise. Again, we'll go back to pull up the Dow Jones this time. Okay, I'm pulling up here on my machine too at the same time. But if you look at this industrials in here, and I was talking about this a little bit for the last couple of weeks, what I think you're going to see is probably you may not get down to this low here that we saw in January, which would be somewhere around 33.2, something around like that. But probably around the 34,000 on the downside, maybe 35.6, 35.7 on the upside. I think you're probably going to be a little bit of a range bound in that area until we get closer to the second week of March, which would be when the FOMC meeting is. I don't expect to see any heroics But it's silly to think that okay, I'm going to go ahead especially if we're up above the 200-day and below the 100-day, to think, okay, I'm going to jump in there and get, be a hero, get in there early, and then for some reason they do raise rates 50 cents. The market's you're going to tank on you. You're going to get stuck. And the same aspect, if you're down, if you're starting to short the market and you think that they're going to raise a half and they come in, they only raise a quarter, we'll probably get a little bit of a relief rally on that also, because it's better than what it could have been, and the market will trade off of that. Now, they're still going to be data dependent, and then we'll start looking at what the odds are, for a May hike, and they're already telling you that they're probably going to they're going to do a hike in May too. So you have these things that you screen out the noise and just kind of go back in and remember and kind of get the big picture, and forget about these little daily guys coming out here and Bullard and everybody just giving their opinion on stuff. That's just one guy. They're getting the headlines for that day, and it's going to move the market up and down. But the big picture is, what Powell's been saying. He's been very transparent, and I think you're looking at, a quarter in March and quarter in May, and and they're going to keep watching the CPIs and the PPIs in here, and they're hoping that within the next couple of weeks we should start to see a little bit of the inflation pull back a little bit. And if that's the case, just a little inkling where it comes in as expected, or maybe just a little bit weaker than expected, then you can probably much ink in the quarter point. And again, that'll be where we start to see the market begin to build off of maybe some of these we can measure some of the pullbacks, and we can start to think that maybe the market can inch a little bit higher going forward into the summer.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.